Ciba Chemical Corporation Takeover of Allied Colloids Chemical, a Case Study by Corey Bly. What caused Allied Colloids to become a takeover target? Hercules wanted to play the consolidation game after selling off multiple divisions in 2001. Rising raw material costs also affected Hercules, as well as competing with bigger industrial customers that could create the same products with lower cost. Hercules saw an entity it could use to compete in the high-growth categories as well as increase its size. Allied Colloids, a specialty chemical company, became a takeover target for multiple reasons. Allied Colloids had a poor share price performance, its disappointing investment performance, and its ineffective response to rising raw material prices. How did Ciba value the gains from the merger or acquisition? Ciba valued the gains from the merger from a synergistic standpoint. The merger would save the jobs in Bradford and the jobs of 3,400 people who work for Ciba around the world. Ciba is closer to Allied's markets and already employs 2,000 people in UK businesses, enabling the extraction of higher cost savings. Ciba's culture and attitude to the environment is similar to Allied's. The ease of this merger relies on the synergies of the corporate culture. Since Ciba is a complementary business to Allied, they should provide a platform for growth. Beyond synergies between company cultures, Ciba also values the financial prospects of Allied Colloids. Integration of Allied Colloids show cost synergies in the areas of purchasing, transport, administration, and insurance. Water Treatment Additives is a high value-added franchise and is complementary with Ciba's specialty chemical portfolio. Management also valued the gains from the merger from in-process research and development. Purchased in-process research and development was identified and valued through interviews and analysis of product development data provided by Allied Colloids, management, and scientists. This data related to the nature of the developmental projects, their respective stage of development, cost incurred, the time and resources needed to complete them, their expected income generating ability, target markets, future uses, and associated risks. What effect did the acquisition have on Ciba's balance sheet and performance? Current assets dropped 7.6% due to the cost of the acquisition. Property, plant, and equipment rose 10%, and other long-term assets rose 232% since the acquisition of Allied Colloids. Ciba's current liabilities rose 2.7%, long-term liabilities rose 160%, and shareholders' equity dropped by 24%. Sales increased 7.6%, mostly due to the newly acquired wastewater treatment sector. Operating income increased by 2.7%, net income dropped by 35%, EPS dropped by 33.5%. Although the drop in EPS is significant, Ciba Specialty Chemicals Holding Inc. Chief Executive Herman Bodica said the acquisition of Allied Colloids Group plc will have a positive effect on earnings per share as early as 1999. Even though operating income improved in 1998, Ciba could not recover from the increase in invested capital acquired in the Allied Colloids acquisition. The company therefore achieved a result in line with its cost of capital. Economic profit amounted to $6 million compared to $64 million in 1997. Who won and who lost? Ciba chairman Rolf Meyer said that his group had been looking to buy a water treatment business for 18 months and therefore had been in a position to jump as quickly as it did. In January 1998, with a bid of $1.42 billion cash offer, Ciba won Allied Colloids. They defeated Hercules in the battle of the acquisition. Going into the merger, Ciba had a strong balance sheet. With the first half of 1998, Ciba had a rise in turnover and a loss of 792 million Swiss francs due to the acquisition. Ciba also implemented a skills concentration program. Like with most acquisitions, requires the melding of minds, which will reduce the workforce further by 1,000 jobs. To further complicate things, due to the acquisition, Ciba incurred a 24 million rise in financing charges. Weakening market conditions for the textile, paper, and plastic industries further weakened margins. In January 1999, former Chief Executive David Farrar stepped down from the executive board of Ciba. Weak sales in the first quarter of 1999 due to the intense competition in all sectors. Not all divisions could compensate through volume gains. Ciba's management shows support for aggressive cost reduction programs, but is leery of the industry low Ciba hit in mid-1999. If trends continue, weakening economy on sales and margins, and the net effect that result from that, as well as cost savings, it will not be possible to maintain the current EBITDA margin levels. And a brief postscript of the case. In the beginning, Ciba saved thousands of jobs and became a leader in water treatment and became the world's biggest maker of colors for plastics. It appears that due to the takeover of Allied Colloids, the company has been unsuccessful in maintaining the profitability of its core company. Ciba overvalued Allied Colloids and couldn't recover from multiple problems the acquisition as well as external factors caused. Around 1997-98, when Ciba began the process to acquire Allied Colloids, oil prices were dropping. One of Ciba's main cost centers is transforming crude oil derivatives such as ethylene into pigments, plastic additives, and dyes. Asia was going into an economic crisis, so oil production went up and oil prices dropped. This allowed Ciba's low oil-derived raw material costs to be passed on to their customers. In 1999, oil production was reduced and oil prices were once again on the rise. The oil markets fluctuated over the years and essentially rose from below $20 a barrel in 1998 to over $80 a barrel by the end of 2007. The higher raw material costs, lower sales price, and unfavorable changes to product mix and the performance polymers significantly reduced profit margins. In 2004, Ciba added $572 million in sales from the purchase of finished paper chemicals maker Ratio in 2004. Since then, the units have dragged down the margins at water and paper treatment, its biggest division, as input costs rose and a global forest products glut forced papermakers to cut output. In 2006, Ciba had to sell its textile dyes division because of increased competition from Asia. In 2009, BASF offered 50 million francs in cash for Ciba's share for a total of 6.1 billion. The merger went through, and now Ciba has become an excellent strategic fit for BASF. Thank you.